Hi there, and thank you for joining us in this episode of PhillipCapital's Market Watch. I'm Wee Kuang, research analyst from Phillip Securities research team, covering the banking and finance sector, as well as the healthcare sector. With the onset of the recent oil price war, coupled with an escalating threat of a global pandemic from the novel coronavirus outbreak, we have observed equity markets exhibiting a strong sell-off sentiment in recent days. In particular, the STI has fallen almost 15% off of its peak this year. The decline is largely attributed to the poor price performance of banking stocks, which constitutes more than 30% weightage in our 30 stock benchmark index. As a result, many investors may be concerned about the outlook of the local banks given the current macroeconomic conditions. Therefore, I'd like to take the opportunity today to share with you some of my recent observations with regards to the banking industry. Firstly, there are worries that the recent interest rate cuts by the Federal Reserve of 50 basis points might compress net interest margins for the banks. Indeed, our 3-month Singapore interbank offer rate as well as our swap offer rate, which are proxies for local lending rates, have fallen in recent days to mimic the trend in the US interest rates. However, when putting the lending rates against the bank's net interest margins from 2013, we can observe that net interest margins tend to exhibit more resilience against fluctuations in lending rates. As such, even though lending rates have fallen to levels last seen 2 years ago, the banks should be able to minimize the impact on their margins. The risk is therefore contingent on the bank's ability to respond to the pressure from margin compressions, especially if the US Federal Reserve plans for further rate cuts ahead. The second worry comes from a slowing loans growth with poorer business sentiments. Domestic loans grew 2.97% year-on-year in January, confirming market sentiments of a sluggish loan environment, especially within the consumer loan segment. As such, we should continue to see some pressure on loans growth that would pose greater significance to earnings for the banks. Nevertheless, while banks will be facing some oncoming headwinds, the bank's commitment to prudent capital management has bore fruit for investors. All three banks have increased their dividend payout in 2019 from 2018 and is expected to maintain current dividend payout levels in the current year. Based on current prices, the dividend yield will be attractive to present and new investors alike. And that's all for PhillipCapital's Market Watch today. Do remember to like and follow us on social media and subscribe to us on YouTube. Feel free to leave a comment below and share with us your opinion on your outlook of the banking industry in this current volatile environment. Thank you and see you again soon.